Hello, in this lecture, we're going to define the term of a T account. According to Fundamental Accounting Principles, wow, 22nd edition, the definition of a T account is tool used to show the effect of transactions and events on individual accounts. It's important to note that we are talking about a tool here, meaning this is usually a shorthand way for us to show the detail within a particular account. A shorthand way for us to show the debits and credits, a shorthand way for us to show something similar to a general ledger, which would be the more formal account which would show the detail. For example, we might have a T account for cash, and if we're trying to see, okay, what would be the impact of cash of some transactions, and we said, well, cash would go up. What if it went up by 10,000 for whatever reason? It would be a debit to cash, and then if we were to spend cash, there would be a credit to cash, making it go down. If we were then to add up the debits and credits in terms of cash being an asset, the debits would then be winning, and we would say we have the balance of 6,000 in the cash account. So a shorthand way for us to give us that data to analyze, usually by hand. If we were to do this with accounts payable, which is a liability account, we could do the same thing. What if accounts payable went up? Well, it would be a credit. And then what if we paid off the accounts payable, the liability, that would be a debit, bringing it down. And if we looked at the balance, the 1,000 credit minus the 300 debits means the credits are winning. It's accounts payable liability account. That will always be the case. In this case, by 700. So it kind of simulates what the GL might look like. And then we have the revenue account. We can do the same thing for a revenue type account. Revenue goes up with a credit. So just about everything that goes into a revenue, because it's an income statement account and only goes one way, will usually be just a credit. So we can say income went up by 2,000, income went up by 5,000, and so on and so forth. That would then mean that the credits then are 2,500. We can do that for expenses. Expenses also be an income statement account. They only go up in one way, but they go up in the direction of debits. So expenses, we're going to say, well, expense could go up 400, it could go up 200, and then if we added up all the expenses for this particular expense, in this case, it would then be 600. So this would be a shorthand way for us to look at the detail if we're working problems and we're trying to see what's going to happen. Oftentimes, if we're doing it by hand, a T account is a good way to go.